I'm Amalia. I've been in the space for quite a while. I don't want to tell because I don't want to tell my age. But I've worked in various positions. I think it all started because I studied information and communication system engineering, and then I started working for Glamour magazine. So I got stuck in the fashion tech twilight zone ever since. I think most of the people in London know me through my works at London College of Fashion, where I designed and launched the Front Row IO, which is an accelerator for fashion tech startups. And I'm here to talk about funding, and I'm going to let my panel introduce themselves. Let's start with Justin next to me.
Hi everybody, I'm Justin. I work at Harbottle & Lewis, which is a law firm in the West End. We advise lots of startups and investors on angel investments and later stage investments as well. So if you have any questions about the kind of more technical aspects and how you should be protecting yourselves as entrepreneurs, then I guess I'm your man on a certain level, but the other panels of members I'm sure will have equally amount to contribute.
Hey there, I'm Chabot. So I've spent about a decade and a half working for companies like Google, Twitter, founded some startups as well. I've always been intrigued by this notion of disruptive technological change because it impacts society, right? It's the most fascinating space to be in. I'm sure you all agree with me. The last year I've been running an accelerator program doing investments in a group called Fiedler Capital.
Hi guys, my name is Piers, Ridyard. I started out as a lawyer, but then when I founded my first company, I was making this little device to increase the storage in the MacBook computer, which I made for myself because I ran out of space. And I put it on Kickstarter as a side project, and it kind of went a bit crazy, which meant that 3 years later, I'm now running a medium-sized, small to medium-sized consumer electronics company. And recently we launched a wearable tech company as well called Zoo. And we've done a joint venture with some Americans. And Zoo itself was a collaboration with Casely Hayford, which is a fashion design company in London. And it premiered on the catwalk this January. So we've done two funding campaigns. One was Kickstarter, one was Indiegogo. We've raised venture capital, we've raised private institution money, and we've also done mergers and acquisitions as well. So if you have any questions on those kind of things, then I'm very happy to answer your questions.
Thanks. Morning, my name's David. I'm from Forward Partners. We're a venture capital firm. We invest primarily in e-commerce startups, and we go very, very early stage, even before there's a product, even before there's customers. So we do very early stage investing. My background is not as an investor. I've been doing this for about a year and a half. Prior to that, I was working in startups as a chief operating officer, a number of different startups who had raised Series A money and were on a growth trajectory. They included Bookertable, Housetrip, and Iavox. And so I've probably done more deals raising money from VCs than I have on the other side of the table. And I've been in tech since about 2000 when my first startup job was as a product manager building a ski booking website. So here to explore the early stage investing.
Okay, great. So as you see, I have all stars here. So I'm going to start my questions with David and Chris. I want to ask both of you. Now, a lot of time we ask investors, what are you looking for in an investment? And they'll say, oh, the team, blah, blah, blah. But what is it really that make you go from to, like, what are the red flags?
So I think I'm going to have to disappoint you. It depends a lot on the stage that you're investing in. When you're looking at a Series C, it's more of a banking deal and financial projections than when you're doing early stage startup investment, right? And the thing with early stage startups is no one has any idea of what's going to be successful. I think that's our dirty little secret. And there's all these stories about these music guys
so
that miss signing. Like, there's a lot of people that skipped on Uber or the Beatles or Google, or of course they all hated themselves for missing those opportunities. But it's all based on the fact that no one has a single idea of what's going to be successful because nobody can tell the future. So there's of course things that you know are gonna fail. Like if you have two founders that are quarreling with each other while they're in a meeting with you, they're probably gonna have a big fight and break up. So that's a red flag, right? On the other hand, if you have founders that have done substantially impressive things in the past, you kind of go like, well, these guys know how to get shit done, so they're probably the right people to invest in. Likewise, there's definitely some trends in the market. Are you too early with your technology? And are people not going to get it? Well, that's probably not a great investment. If on the other hand, you kind of go like, these guys are at the beginning of a major wave, this could be one of the major players in the future, you kind of go like, my spidey sense is tingling. This could be really freaking cool. So I think that every investor has like this list of things they look at, and it's timing, it's team, it's product, it's if they know how to build a business, if they've done it before, if they've done anything else interesting in their life. Have they trained dogs in the circus? Well, at least they know how to persevere and make cool shit happen, right? If on the other hand, they joined a book reading club and they've never done anything in their life, they're probably not the guys who know. Well, clearly, we've got a book reading club member here. I'm so sorry, I didn't mean to point you out specifically. So there's this matrix of factors that you look at, and if enough of them look decent and there's not too many red flags, that's kind of where you go like, well, maybe this could be a good investment, but you still don't know. The one thing I will say is that you can iterate your way out of a bad product. You can't iterate your way out of a bad team. So that's why we do always say like team is really important, because if you've got some smart people who know how to get stuff done, even if they start out with a bad product, they could probably turn it into a good one. But if you have a good product with a terrible team, they can probably never make it a success.
David, do you have something?
Yes, some great points there. There's really three types of risk when you're putting a startup together. One is the people risk. You know, how good are the people? How effective could they be? There's the market risk, and whether the opportunity is there, and then there's the product risk. Is the product suitable for that market? So at a meta level, those are three big themes. But there's probably three things that stand out for me that I would say are red flags. And the obvious ones, I think you probably all know. But one in particular for our type of investing would be a high dependency on working capital. So if a business model requires lots of cash to be spent up front to create a product to then store, to then sell, that is less attractive than a product where you can be paid up front, go and put the product together and ship it, and then pay your suppliers. The working capital required there is substantially different, and it makes a difference to how quickly you can grow that business. So I'd say a high dependency on working capital is the first thing. I'd also be looking out for how well does the founder or the founders, how well do they know their customers? What evidence do they have that their customers have this need, and it's a real need, it's not an imagined need? And that can be evidenced by lots and lots of interviews with customers. It can be evidenced by surveys, by research. But if the founder or founders have spent time with their customer base and really understand what's going on inside their heads, that for me is a big plus. And if I'm not seeing that, that's a red flag. I'm really looking for, does the entrepreneur understand their buyer? I was talking earlier with a guy here who was looking at doing a startup, and he'd identified an interesting problem, and he'd come at it from the supply side, from the designers, from the brands, from the retailers, looking at their problem. And I pointed out that the most important element here isn't the supply, it's the purchasers, the people buying, and what are their needs, and how do you reach them? So that leads me on to the third point, which would be around, I guess, the market opportunity, the size of the opportunity. There's lots of great businesses that we see, which are great businesses, and they can be profitable businesses, but they're not right for venture capital. Venture capital has an extraordinary expectation of making a high return. Every single company we invest in, we're looking at to be the one company that completely returns all the value to our fund, because there's only a few that will. And so we have to make that kind of bet on every single investment. So we're looking for companies that we think can exit for 100 million, 200 million, 300 million in a 5 to 8 year time frame. And for that kind of exit, you've got to think, well, this thing needs to be doing 10, 20 million pounds of net revenue in 5 years' time. Well, how many units does it need to ship? Or how many transactions per month is that? Well, then how many consumers does it need to reach? Or how many businesses does it need to reach? And just doing that back of the envelope analysis tells you whether this opportunity is big enough. So a lot of companies come to us, and the red flag we always have to look at is how big is this opportunity? And if it's niche, then we have to walk away. So I think those are the three things from our perspective.
Okay, thank you. Piers, you mentioned before that you had a very successful Kickstarter campaign, so I was wondering if you have any tips for somebody who is considering to go down the crowdsourcing path, and if there are like any hidden dangers that people don't know firsthand, like how can you decide if that's for you and your company or not?
Yeah, so there's loads of tips that you often hear said, but I'd say in terms of thinking about how you're going to price and position your product on Kickstarter is massively important, but also there's a massive danger in that. So Kickstarter's got this really interesting sweet spot, which is between $30 and $50. A lot of campaigns are overfunded. If you sort of analyze the data, between $30 and $50 if that's what your product costs. But you have to be really careful as well, because you need to make sure that there's enough margin in there for you not only to be able to pay for the tooling, but also pay for any fuck-ups that you might make, and you will make fuck-ups. So our first Kickstarter, we got this right entirely by accident, because we originally did an Indiegogo campaign that failed, and so the product was the Nifty mini drive, which is a little device that sits in the side of your MacBook. It's completely flush with the side of it. It sits in the SD card slot and can up to double the amount of storage that you have available by doing that. My original one, I CNC'd the entire body out of aluminium. Really expensive process. So when you wanted to do even $1,000 off, you're still paying $40 to $50 per CNC'd aluminium enclosure, right? But that failed, but that was the pricing that I did on the first one, and we had enough people, we did it on Indiegogo, we had enough people, we had about 50, 60 people who were really keen on this product. They really wanted it to succeed. They really wanted to see it delivered. So we sort of took the learning and mistakes that we made on that first one, and we re-engineered it and said, well, actually, it doesn't all need to be aluminium, because you can only see the end bit of it. We only need to make it out of the same grade, the bit that you can see on the outside, the same grade of aluminium that the MacBook is made out of, but the rest of it we can do it out of injection molded plastic. And then bring those two pieces together and put it in the computer. That brought our costs down substantially. So we are now looking at a $3 cost, $3 to $4 cost, rather than a $40 to $50 cost. However, on our first one, we were selling at $50 to $5. We only dropped it to $40 to $40. I think it was $35 on Kickstarter, $35, $40. So we're still making a 10 times margin on costs when we did it, and we absolutely needed it, because we had to do all our tooling twice, because the first time it didn't work properly, and we had a load of failures because the design wasn't good enough for the mass market. So our campaign was $400,000. And then after that, we took another $200,000 in pre-orders before we actually shipped. And since then, we've shipped over 80,000 products globally now of just the mini drive. But it's so important that you don't just do a 2 times multiple or less, or even a 3 times multiple or less when you're looking at doing your Kickstarter, because unless you have a massively experienced team who has taken something exactly like this to market in the past, and when I say exactly, they really have to have done something really in the same field, you're going to make mistakes, and you need to have margin, because otherwise what's going to happen is you're not going to be able to deliver, or you're going to have to raise money at a massive lower value than your company is worth, because you're going to be in a state of panic because you really need this money, and that's just going to give you grey hairs. But more importantly, if you do get to the end, you can't raise money, you haven't delivered, and you've spent all the money, people are now suing people on Kickstarter as well. So there are class action lawsuits that are happening in the US. So it's not a small undertaking anymore. It's not just people aren't betting on you. They're actually buying and they expect a product. And while you're still going to deliver it, it doesn't matter if you deliver it late as long as you're still going to deliver it. But as soon as you say, I'm not delivering it anymore, then you're opening yourself to liability, to being sued. So you need to really think carefully about how you structure your Kickstarter campaign, that there's enough margin for error in there, and that you really, really, really get your design right before you go to tooling.
Yeah, sure.
So I'd just like to ask you guys a question. Talking about crowdfunding. So as venture capital investors, if you've seen that a company has run a successful crowdfunding campaign, which presumably would go some way to proving the marketability of the product, as you've discussed, how much attractive is that to you as an investor? Would you take that into serious account when you're looking at a company in terms of when you decide to invest in it? Or do you simply think, okay, well, I'm still relying on my own due diligence here and that doesn't really make a difference to me in making my decision?
Yeah, so it used to be that if a company had raised money crowdfunding, it would have been seen as kind of almost like a bad sign, that they couldn't raise the money elsewhere and therefore they had to do crowdfunding. But that's no longer the case. I think in the last 18 months, crowdfunding as a category has been validated, and when companies now come to us for investment, and if they've previously had investment, if it's come through crowdfunding, we think, yeah, great, that's good. We don't use it as a marker for whether or not we think it's a good investment or not. The fact that 200 people have invested in a startup on its first fundraising versus 20 versus 10 versus 2, we don't really take much notice of that. It does lend itself to companies which have a large consumer base that identify with the product. So there's a couple of companies that we've backed that have subsequently gone on to do crowdfunding, and it's worked for them. So I think the era of crowdfunding being a questionable funding source is definitely past.
Sorry, can I just ask, are you talking specifically about equity crowdfunding or about product crowdfunding?
Equity crowdfunding.
Right, okay. So just to be clear, I was talking about product crowdfunding where you give up no equity of your company. That's Kickstarter, that's Indiegogo. David's talking about equity crowdfunding, which is Crowdcube, CloudBank, those kind of things. Very different. So just the same question, but what's your view on if a company has raised no equity but has done a successful product crowdfunding campaign?
That's fantastic, because you're validating the model. You built a prototype, you're getting some customer feedback, you've got real customer feedback rather than supposed customer feedback, and you've done it in a way that hasn't used up a lot of working capital. So definitely a big plus.
So I'd definitely like to add to that, like the Kickstarter crowdfunding to me is actually a really good sign. So the main problem a lot of founders run into is that they think their own product is amazing. And of course you're supposed to think that you build it, you put your blood, sweat and tears into it. It's fucking awesome, clearly. Now the problem is convincing other people that your product is awesome. And that's kind of where the gap exists for most products, is that they never get to the point which we call product market fit, where you've got a product that people are willing to actually spend money on. So that's the big gap, right? From that 0 to that 1. So Kickstarter is an amazing validation, not just of the fact that people like the product and are willing to pay for it, but I think an additional really valid point is that Kickstarter is a little bit like investing. Only the top 10% really do well on Kickstarter. I don't know if it's exactly top 10%, but it's a very small margin. Most of the Kickstarter projects never get backed. They never succeed. So the fact that you're in the top 10% tells me something, that it's not just a good product, but it's a product that people love talking about, because that's kind of the thing that drives a great Kickstarter, where people go, wow, that is really interesting. And look at some of the most funded campaigns. It's beer coolers with sound systems built in for chilling out at the lake, right? Or jackets that have built-in travel pillows and hoodies that you can pull over your eyes so you can sleep in an airplane. Or there's all these things where you go like, whoa, that's weird. That's remarkable. It's different. And it's so remarkable that I'm now going to be cool if I tell other people about it in the bar. Hey, have you seen that beer cooler with the sound system in it? I got one, dude. Like, now you're the man telling awesome stories about this product. And those other guys are going to go, whoa, I need one of those. You know? So that little differentiation of a good product to a remarkable product, I think, is something that makes your product so much easier to market because people want to talk about you. And it's easy to build a decent product, but that's very hard to market. It's hard to build a product that is really great and markets itself. And to me, a successful Kickstarter campaign is a fantastic signal of like, this is a great product that's marketing itself.
Okay, so what I'm going to ask is, getting money out of investors is a lot of times easier than getting feedback out of investors, because you usually get, oh, too early for us, but do stay in touch, and that's that. But how can you manage your relationship with investors, whether you have taken money out of them or not? Like, how can you better stay in touch? What would be your advice to kind of maximize the relationship you're building with investors, in case that leads something down the road, or how can you really make the most out of these meetings for you? Justin, would you like to start?
Well, depending on what form of investment you take, if you are taking investment with venture capitalists or business angels, it's fairly common that they will want to have a representative on the board. So that is probably the best way of making sure that connections with investors are maintained. They're going to want to have certain information provided to them as a matter of course, so they can monitor the business, provide help where it's required and guidance, or alternatively, if you're not doing what you said you'd be doing and performing in accordance with your business plan, then maybe show a bit of tough love on the other hand. But that's generally the way that I think relations would be fostered at the beginning. In terms of other ways of raising funds, we've already talked about kind of peer-to-peer crowdfunding or product-based. That's a different story really, because the only way you're really engaging with your investors is through your delivery of your product and the quality of your product. You don't really need to engage with them in the same way, bar the standard information you provide about the company on the particular crowdfunding platform.
So I think one of the things that really confuses founders is exactly when we tell them like, hey, we think it's a little bit too early for us. So I'd like to unpack that statement just so you understand what people are actually saying. And don't use this against me if I ever invest in you. So pinky swear, right? So when we say it's a little bit too early for us, what we're really saying is we're not investing. It's a no. However, that should be clear, right? We're saying we don't think that right now this is an investable thing. However, investments come all the freaking time, and it might be that these founders do figure out how to make their product awesome. And if that happens, we want to be part of the deal, right? Because that's how we make our money. So on the off chance that you do turn around the problems that we're currently seeing, we want to have a great relationship with you guys. Or maybe the product does fail, but the next company you're building could be freaking awesome, because you've got a lot of experience, you learn a lot of things doing your first company. So we want to be friends with you, and you don't become friends by saying, well, sorry, your product sucks. Yeah, that's not a good way of building a relationship. So when
honesty is a good thing in relationships.
It depends. Yeah, it's very situational. So generally speaking, when we say it's a little bit too early, or hey, we don't think this is a great fit for our portfolio, any of these kind of template statements kind of means we don't think this is an interesting investment. It's a no, but we might change our mind in the future. So how you can use that to your advantage is they still want to have a relationship with you, and if you prove them wrong, they want to invest. In a way, that's an opportunity. So you can ask them, hey, what are some of the numbers that you would like to see changed for you to think that this would be a great investment for you? And then focus on those, keep improving your product, send them an email every couple of weeks saying, hey, I'd just like to share with you how my startup is doing. We've really made a lot of progress. We've turned all these things around. And then you can turn that no into a yes. So that would be my advice.
Piers, have you ever been told that it's too early, or you?
I haven't actually asked straight out for money more than once. I seem to meet investors and we sit down and we have a chat, but I've only ever raised funds once, and that was when I really wanted funding. Everything else has just sort of been conversations to see if there would be a good fit, but it hasn't been, we really need the funds right now. A little bit too early for us. Yeah, you get all sorts of template ones. Like every time you speak to an investor, like don't be offended by it. Like I do hardware, and a lot of investors don't like hardware, and that's fine. I mean, David was saying about capital intensity of a business. Hardware is capital intensive as by rights, because your manufacturers will often ask for 100% upfront. If you're lucky, 50% upfront. If you're very lucky, 30% upfront, but everything else on delivery. So it is by rights a capital intensive business. So, you know, me and David would probably never end up doing business together. But there is also the fact that investors know lots of other investors. So on the entrepreneur side of things, don't take someone saying, oh, it's a little too early for us as a bad sign. Absolutely ask those questions. You know, what would you say we need to improve? Like, what numbers would you be looking for? But also, if it's a bit too early for you, do you know any funds who might be interested in this kind of investment? Are there some earlier stage funds that you normally use as lead into funds or something like that? So you can use that no as a intro. If they like you and they want to stay on your good side, you can use their contact book, which is going to be better than yours.
Yeah, and so all investment firms have investors, which is kind of something I've come to realize over the last year and a half. So we go out and raise money, and we sell a promise. We say we're going to be investing in the best e-commerce startups coming out of the UK. So if someone comes along to us and says, hey, I've got this great ad tech business, we may well say, that is a great ad tech business, but it's not what we do. And that is a legitimate kind of, actually, that's not what we do. And so there's some standard replies that we have that we'll use replies like that. And so saying no to someone isn't saying no to your business. It's just saying no to your business for our investment strategy right now. And there's lots of other things in this investment strategy. So you know, we will see 2,000 approaches each year. We've got a CRM system. We know exactly who we've seen each year, each month, and it's all there. And we'll probably do about 8 deals each year. So 2,000 down to 8 is a lot of filtering that goes on. And a lot of it happens on the first email. And a lot of it is just really, is this meeting our investment strategy? Now, all funds will have an investment strategy. Some of the larger growth funds will only want to go in if they're putting in $1 million or $2 million, because any less, and then they've got all these small investments and all these companies to look after, and they've got all these board seats. It's just too much for them. So legitimately, they say, well, if it's less than $2 million, we're not interested. On the other side, we're more interested in the 250,000 to 400 range, and so if companies are raising at that level, then it might be a good fit for us. Strange enough, we would never say it's too early, because we actually invest in companies prior to product, prior to customers, prior to having a team. We'll actually back a solo founder with a spreadsheet. So I think we're probably the only VC firm that does that.
Are people pulling out their computers and building spreadsheets right now?
In e-commerce. And the reason for that is that we partner with the companies. We've got our own team of engineers, designers, product and marketing folk that work with the founders to build out the first version of the product, find the first customers, help build the team, and they're working out of our offices. So it's a very involved model. But we also make investments at the seed stage, which is, by definition for us, that's where you've got a valued product, but you're still building out the business. You've got a product, you've got some customers, you've got a small team. And sometimes we might say to businesses that have gone past idea and have started building something, you're too early, because we don't think yet that you've got to that valued product kind of milestone, and that's where we do our next set of investing. And the kind of gap between idea and valued product is a no man's land that we find quite dangerous. We'd prefer to go very, very early and get involved, or get to the point where the product has got some traction. So I personally try and give as much feedback as I can every time I say no, and I'll be as honest as I can. And I have had entrepreneurs coming back and thanking me for my candidness. And I try and be candid to be helpful. And I'll literally say what I'm thinking, but I'll try not to offend people. And where possible, I will make referrals. But it's not possible to do that level of detail on every reply when you've got 2,000 applications coming in with a team of 4 people handling it. So sometimes the replies are quite succinct.
Can I just riff on one of the points you made? And that's what's not often clear to founders is that there are certain points in time of a company that you're more or less attractive to invest in. So there's definitely the ideation stage where you say, I've got a spreadsheet, I've got an idea, I've got a passion. So that's one stage. But then there's this little gap between I've got an idea and, hey, I've actually have an initial product, an MVP, a couple of customers that like it. Until you reach that point, you're kind of unfundable because it's this no man's land of insecurity. But after that point, when you get that funding or you go beyond the initial few customers, and you see you've got 2,000 customers, a product that sort of works, you're not very well fundable either. Because you probably already had money, or the product just isn't working in the market because you've never made it to 10,000, 100,000 or whatever amount of customers. So the next point of funding, the seed and the A, you have these different proof points. It's idea, it's initial traction, then it's, hey, there's quite a bit of traction, it's starting to hockey stick up quite a bit. And then there's the, we don't just have users, we figured out our business model and we're making money, we just want to accelerate that. And that's what I would call the Series A round. So between those phases, it's incredibly difficult to raise money because at that point you should have had money already. And hopefully you raised enough to make it to the next milestone. I think that's one of the really important things to keep in mind when you're thinking about valuations. Because between those points, you're not going to be able to raise very easily or very difficult terms at best.
Okay, thank you guys. Thank you for your insights. I hope you enjoyed our little talk. Unfortunately, there's not enough time for questions, but you can stalk everybody on social media. That's why we have this slide over there. And of course, they will get off stage, so make sure you're standing by the door or something so you can block their way.